Welcome to the What to Watch video update. This is a video that I do once a week or on an as-needed basis as things change in the market, where we really hone in on the charts that are speaking to us right now. I do a number of different videos each week. I do a video each day. I do a weekly video. I do an intermarket analysis video. The video right before this one is called the deep dive video, where I go through charts that aren't really speaking to us loudly because we have to dive deeper to see if there's any meaning that are coming from those charts. And then the final chart that I do each week is called the What to Watch video. I have a positive section, things that are looking stronger right now, and then a negative section. And this is what I'll be really watching as we start the upcoming week on Monday, June 10th. Before I get going with that, please know that I do have a program called the SPX Investing Program. It is now launched. It launched just about a week ago. If you're interested in this, there are links about the program, both on Rumble and on YouTube. There's also a link in the description on how to get to that site. And it's free for the month of June. So if that's something that is of interest to you, please feel free to check it out. It won't cost you anything other than an email address, but if you end up not liking it, just unsubscribe, and that's all about that. But please feel free to check that out, and I'm loading up more things all the time. I'm also doing a lot of matching up pages and setting up hyperlinks and all that, so it's a little crazy right now. So it's kind of under construction while it's live at the same time. The daily videos that I do, you have to be a member of the SPX investing program to get to those videos right after they're prepared. If you're not a member, they become public right when the market closes. So for example, Monday's video is already available to members. It won't be available to the public until we close Monday in the stock market. So just something to be aware of there. All right, let's go ahead and look at the positive side first. A week ago when I did this video, we were actually on the negative side with this. We're still not trending, and there's a lot of things that we get from this chart. This is one of the more important charts that I follow. I call this a primary indicator. This is called the ADX, or average directional movement, and it gives us a lot of different information. The main index is this black line. When it's going up, that just means the trend is getting stronger. Doesn't tell us the direction. It just means that we're getting stronger with the trend. I plot a moving average on here as well to give it a little bit of context. Right now, even though we're trying to turn up, we're below the moving average. So that suggests a weakening trend. There are also static numbers on here, and depending on how you use this indicator, I've found that 20 works pretty good for the S&P 500. I've seen other people use 25, maybe even 30, but this seems to work well with the S&P. When we get below that 20 level, that means we're not trending and we're still weakening with the trend. So we're looking, at least I'm looking at doing some different kinds of strategies. These are things that you implement in a non-trending environment, and we can take advantage of that. Another thing that we get from this is which line is on top, the green line or the red line. Well, a week ago when I did the video, the red line was on top. Now we've seen things turn more positive and the green line is on top. So we do default to positive when looking at this chart, but we are in a non-trending environment. What we want to see is the green line to continue to go up, the red line keep going down. We want the ADX to cross above the moving average. That's step number one right here. The confirmation would be once it goes and crosses back above 20. So we'll be seeing if something like that plays out in the upcoming week. We're keeping an eye on sentiment. This is the Fear and Greed Index by CNN Money. And I wasn't sure whether to put this on the positive or negative side because we're kind of in the middle right now. We're more neutral. We're not getting an extreme positive reading, which is above 75. We're not getting an extreme negative reading, which is below 25. We're just a little under 50. And when we're from 45 to, I believe, 55 or so, that's more of the neutral reading that we're seeing right now. But we had been coming down and we seem to be stabilizing a little bit. So I decided to put this on the positive side. If we have a downward move with the S&P 500, this is going to go down as well. If it's going up, typically this will go up as well. We're also keeping an eye on the VIX. This is the fear gauge. We're getting very low readings again, both with the line chart. This was the closing value on Friday. and with the bar chart, fear goes down, which is what this chart is doing, when stocks go up. And even though we didn't see a lot of action, especially after the employment situation report came out, we're still seeing fear tending to decrease here, and that's where things tend to turn more positive. And this is an indicator of the VIX called the VIX of the VIX. And this is also declining, both with the bar chart and with the line charts, showing there's not a lot of fear. Now, a lot of people say when the VIX is low, it's time to go. This kind of makes you think twice about that. This is research put out by Tom Bowley. He's connected with stockcharts.com. He also has another site called earningsbeats.com. I don't know him, never met him, but he published this late in 2023, and I've just been updating this. When we get down below 13, which is where we're at now, we closed at 12.22 after Friday's session. This is when we see the greatest annualized returns. So maybe when the VIX is low, it's not necessarily time to go, at least yet. And then as the VIX starts to go back up, we do see positive annualized returns, but they really drop off from 47 down to about 31%. As the VIX is going up, they're still positive. Now we're down to 15%, so almost half of what we were seeing before, but they're still positive. When we get above 20 with the VIX, that's when we start to see a negative annualized return. So for right now, this is looking more positive for the market. We also look at the equity put call ratio. As a general rule, and there are always exceptions to this, when the equity put call ratio is going up, that's more negative for stocks. When this is going down like it is right now, that tends to be more positive. We did get to a very low reading as stocks were going up here because it was going down that gave us that reading. Then we started to chop sideways, saw a bit of a decline with the S&P, and that's when we saw the equity put call going back up. Now that we've been bouncing back up a little bit here, we're seeing the equity put call ratio falling down. So that's more positive. Then there's some positive things on this chart and some negative things. This is the advanced decline line for the S&P. We're declining a little bit based on price, but we're still above the moving average and we haven't really broken down. Another negative thing is here, if you look up at the top, we did set a recent all-time high with the S&P. We were not able to break out with that based on the advanced decline line based on price. So that's negative. On the positive side, you can see how volume, even though it ticked down a little bit on Friday, it did break out above these previous high levels as the S&P was making a high. And this can often be positive when we see volume actually leading price right now. Now, this you would think could be quite a positive thing. I have tried to point this out in the recent past, and it really didn't lead to anything. Well, there's other times when I pointed this out, and it does lead to something where volume is actually doing a little bit better than price, and then eventually it follows through into price itself. We keep an eye on the new highs, the new lows. This is another internal measure for the S&P where we're going down a little bit with the new highs, but we're not really seeing an expansion of the new lows. So this is tending to be more positive. We're seeing an awful lot of green bars here, which means new highs, and not a lot of red bars, which would be new lows. We had been declining with our 5 period, but we're starting to flatten out here. Our 10 period is still declining, but if we see more of an improvement with this, eventually this 10 period would turn back up as well. Then we have a positive thing and a negative thing here. This is the advanced decline ratio. The blue line is short term, and we've dropped below zero. The red line is more intermediate term, and that's still above zero. So we're kind of getting mixed signals from this chart. Accumulation distribution, this is one of the smart money indicators because it's trying to measure what the big institutions are doing, or what we call the smart money, and volume is included in how this is calculated. It came down a little bit on Friday, but it's still above an advancing moving average. So for now, that is positive. Chaikin money flow, another similar type of indicator where we did come down on Friday. The red line's rolling over a bit, but we're still positive here. And we're not necessarily getting an extreme positive reading. If we do see more upward moves, this could turn and go back up without necessarily getting extreme positive. Chaikin oscillator ticked down just a little bit, but it has been going up overall. It's positive since it's above zero. When we get above this red line, sometimes we get a little concerned about that. So we want to be aware of that as well. But this could also turn and go back up even higher than where it's at if we see follow through buying. We look at a double and triple exponential moving average based on 20 periods. A week ago, this was negative since we were below both of these lines. And I was pointing out at that time, it would be more positive if we could get back above the green and the blue line and then see the green and the blue line turn back up. Well, that's what we see happening now. So this is showing in the short term. That's what 20 periods measures as far as my definition. So we are looking more positive according to this chart. We're also looking a little more positive according to the 50-period double and triple exponential moving average. We were kind of inside before, and this seemed to be acting as overhead resistance. Well, we were able to break up above, and we're still seeing both of the lines going up. Now, it would turn even more positive if we could stay above this and continue to go up with the S&P and then see the red line cross back above the blue line. This is what we saw coming out of the lows last October in 2023. The red line was up. This is the triple, and it moves faster. And when it's going up, that means that there's good, solid momentum. We're not quite there yet with this reading. This is a regular 20-period moving average. I plot both a simple, where all 20 periods are the same, versus an exponential, where it's more weighted to the current prices. And we're above all of these lines right now. So this is also confirming that the short-term trend is positive as long as we're above both of these lines. Then we look at the 50-period moving average. We almost came down to that when we were seeing some weakness in late May. We didn't quite get there, and we bounced up off of that. But we're watching this, and it's turning more positive, and the blue line's crossing above the red line, and price is above both of the lines. So the intermediate term trend for right now is still positive. These are all the different moving averages plotted here, and we're above all of them, and they're all going up. So that's suggesting in the short, intermediate, and even long term, we remain positive. Parabolic SAR, this was negative a week ago. We had some upward movement here, and the parabolic SAR switched from being negative with the dots on top to positive with the dots underneath. This is significant. This is a primary indicator that I follow, and this is turning more positive. This is also being confirmed by the positive readings that we're getting from the weekly parabolic SAR. So now there's confirmation on both time frames. We're looking okay here with the bullish percent index. We're positive because we're above 50. Now, a week ago, I pointed this out because we were declining. We are turning back up, but we're not really showing a lot of conviction right now. We want to stay above 50 and continue to go up for this to be more positive. But I have it on the positive list just because we are still above 50. We're seeing some positive things and negative things here. These are the advanced decline line studies. When we look at the NYSE common stock, we're coming down to the moving average. We're still a little bit above the moving average with the S&P. Then when we get to the mid caps, we're starting to drop below the moving average, and we're also dropping below with the small caps. So the bottom two areas, that's negative. We're still holding up okay with the NYSE common stock and the S&P itself. This is the vortex, and a week ago when I did the video, the green line and the red line were right on top of each other, giving us exactly the same value. With the upward move that we saw this past week, the green line's starting to go up and the red line's coming down, so this is now positive. We look at a cumulative advanced decline line for the S&P, and notice how we haven't really moved all that much based on price, but when we look at the cumulative measure based on volume, see how we're going up? This is part of the reason where we're seeing volume actually outperforming price, which could be positive. We're seeing the cumulative NYSE advanced decline line actually decline in Friday's session below its moving average. That's something to be aware of. We're declining, but still above the moving average with the regular NYSE advanced decline line. So we want to watch this one. And then we have the advanced decline line for common stock on the NYSE, where it is declining currently, but it's declining less when we look at this based on volume. This could end up being positive, even though they're both going down. The fact that volume is going down less than price right now could be positive. Large cap growth just coming off of setting recent all-time highs and above all the moving averages, and the moving averages are going up. So that's still looking healthy. The Dow is in a little bit of trouble. It came up this past week, but it's right at its 50-day moving average. There's also a pivot point here, which could be acting as overhead resistance when you combine the 50-day moving average and the pivot point together. We want to see the Dow continue to go up. The NASDAQ, not really hitting any resistance or support right now. It was down a little bit in Friday's session, but this is looking a lot more positive. We're above the 50-day moving average, and the longer-term trend is up. And pretty much that same thing with the NASDAQ 100. We do have some overhead resistance up here at R1. We're above the 50-day moving average, and the longer term trend is positive. And this switch from being negative back over to positive, this is the momentum of the NASDAQ 100. It had started to cross below its moving average. Well, as we've been going back up here, this momentum is starting to turn back and look more positive. The mid caps, this could actually be on the negative side, but I want to keep all the indexes together. We're below the 50-day moving average, and we've been chopping more or less sideways. Now, on the positive side, we're not falling apart and we're not breaking through support, but we want to see the mid caps, which has been one of the stronger indexes since about the end of January. We want to see this pick up and really start to advance, and we're not really seeing that lately. The Wilshire, this is interesting. This is a broad market measure because when we were coming down, we came right down to the 50-day moving average. That moving average we did hit, and we were able to bounce up off of that, and we're just coming off of setting recent all-time highs here. This is since it's a broad market measure, this is showing that the major parts of the market are still holding up. This is another broad market measure, total US stock ETF, just coming off of setting all-time highs above both of the moving averages and in a longer-term uptrend. The FANG index also coming off of setting recent all-time highs and still looking pretty solid. Semiconductors, a huge part of the tech sector, coming off of setting highs here, not quite an all-time high yet, but still looking quite positive. The tech sector is also looking really positive currently. This is also partly positive and partly negative. This is the 19-day exponential moving average of the advanced decline ratio. This is similar to the red and blue line that I showed earlier, but this also takes volume into account. We're turning a little bit more negative as we drop below zero based on price, but we're still above zero when we measure this looking at volume. So it's negative because we're negative with price. We're still positive here because we're still above zero based on volume. This is another broad market measure that's just hanging on to being positive. This is the MX, NASDAQ, and NYSE. We measure the highs minus the lows across all those indexes and then take a 5-period moving average of those highs minus the lows. We're coming down, we're getting a reading of 43 right now. Now, the majority of readings have been above zero, especially in 2024. So that's still positive. We're going to make note of this if we start to drop below zero. And then looking at the large caps as measured by the Russell 1000, that's kind of equal to the S&P 500. And then we have the Russell 2000, which are the small caps. This is just showing that the large caps continue to be the real strength in the market currently. And that's what helps the indexes go higher. We look at the tech sector and compare it with 3 to 7 year bonds. We're above the rainbow and going up. This means that the tech sector is outperforming the price of bonds. And the market is still anticipating that we're going to have a soft landing, meaning that we're not necessarily going to go into a recession, where that would be a hard landing if we do. Now, this could change at any point, but the market's been banking on this for quite a while now. It's, in fact, going back well into 2023 and then throughout 2024. This is also looking positive, even though it's going down. This is bonds to stocks, kind of the inverse of what we just looked at. We want to see this ratio going down for stocks to remain more positive. There's a long-term chart of the NASDAQ 100. We're still above this long-term trend line going back to 2009. And I'm not quite sure what the perma-bears are going to do with this. They thought this was the holy grail to the market. We came up in the year 2000. This was the dot-com boom. We hit a high level, and then here was the dot-com bust. And then it took, what was that, 19 years or something to finally get back up to this same ratio reading again. And this was right at the end of 2021. Then we went into 2022, which was a very difficult year for stocks. Now they were pointing out that, oh, look, we've got double confirmation here. We're going to come up to this ratio. We're going to hit that again, and then we're just going to tank. And what's this trying to measure is NASDAQ 100, which is growth, versus the Dow, which is, there's some growth in there, but it's more value. And there's 100 stocks versus 30 stocks in this ratio. But the ratio is actually going up and setting a new high here. I'm not sure what they're going to do about that. So for right now, I'm treating this as positive. A similar measure here with the QQQs, again, the NASDAQ 100 versus the small caps. This is breaking out above the recent high levels that the perma-bears just thought was going to offer overhead resistance. Now, it could still turn and come down from here, but that's not what we're seeing right now. Semiconductors to the Dow, also coming back to previous levels and breaking out and setting a new high with this ratio. And then the Qs, the 3 to 7 year bonds, also showing that the Qs are holding up quite well. And the broad market, 3 to 7 year bonds, also looking quite strong. And here's the S&P 1500 to shorter term bonds. This is also looking strong currently. The Eurozone, stocks in Europe compared to 3 to 7 year American bonds, not showing the breakout that we're seeing, but it's still up near the high end of the rainbow. This is what we want to keep an eye on. And the 10-year yield going down, that's what gave support to stocks. What's concerning us is look at the big spike up that we saw on Friday after the employment situation report. I could have put this on the negative side, but most of the prices lately have been coming down. Interest rates going down will benefit stocks. If interest rates continue to go up, that's going to pressure stocks in the current environment. Now we go over to the negative side, where we're looking at moving averages just based on the S&P itself, where we're declining with the 20, 50, and even declining a little bit with the 200. We want to see these going up, and they're going down. Then we look at the stocks inside of the S&P that are above their 20-period moving averages. We're declining and we're below 50. This is shorter term negative. Now, this could change. It could rectify, but we want to see this really turn and go up and cross back above 50 to turn more positive. Here's a study that we did where we came down and got a reading of below 10, and then not too long after that saw a thrust up, giving us a reading over 70. That's similar to what happened back in March of 2023. And then you can see what happened after that. Now, it didn't mean it went straight up from here. We had some down times, we had some sideways times, but this led itself to the market being positive later. We're wondering if that's what's going to happen now. We're going down. We haven't necessarily turned negative here, but we want to see this improve pretty quickly if the short-term trend is going to remain positive. And then we're also just a little bit below 50 when we look at the stocks inside the S&P above their 50-day moving average. We want to see this cross back above 50. It's just slightly under right now. Now, this is still positive, but it is declining. These are stocks in the S&P above their 100-period moving average. And we're also seeing a decline with those stocks above their 200-day moving average. We want to see all of these moving averages going up if we want to remain more positive. The momentum for the VIX has been up as we were seeing some pressure in the latter part of May. Well, now with the VIX coming down, we're seeing the MACD, which I use to measure the momentum here. It is rolling over, but it hasn't quite crossed up below its moving average yet. This is a concern too. We're seeing volume really dropping off. This is a volume oscillator. It doesn't take just one day into account, but we had a really big day, and then we've just been trailing off with volume ever since then. And that's just showing a real lack of conviction. We're seeing some improvement here with our oscillators. The top two are short-term, the slope and the TSI, where we're actually turning back positive with the TSI. We're starting to roll back up with the slope. Then I have 3 intermediate-term oscillators. The MACD is starting to look a little more positive. The PMO's turning back up, and we're looking pretty much a little more positive to right on top of the moving average with the PPO. And then we look at our long-term oscillators, the TRIX and KST, they're right on top of their moving averages right now. We want to see all of these turn and go back up to show that the momentum is positive. This is also a concern, the NASDAQ 100, which has been leading the market higher. You look at the bullish percent index, which measures the point and figure buy or sell signals inside of the NASDAQ 100, and this is below 50. It is coming back up, but we want to see this cross back above 50 and continue to advance. Right now, it's negative and something that we've been watching. The McClellan oscillator, something else that we want to be positive, but is actually negative. We're below 0 and declining. This is short to more intermediate term for the S&P. And when this is negative, meaning that it's below 0, then the summation index based on price, which is more intermediate to even longer intermediate term, we're declining based on price. We're declining based on volume. We might see a little bit of bottoming out here based on volume, but we want to see this turn back up. Sometimes volume will turn and go up before we see it on with price. So that's what we'll be watching for. But right now, this is negative. We're also seeing that same thing with the NYSE McClellan oscillator, below 0 and declining. So when we look at the summation index for the NYSE, we're declining based on price and volume. The Swenlin Trading Oscillator. This is another primary indicator where we're actually dropping below zero based on price, but that's the negative side. When we look at volume, we are declining, but we're still above zero when we look at the volume here. We want to see both of these lines turn and go back up to turn more positive. Now, on an intraday basis, growth to value has been holding up. We're seeing the blue lines above the red lines here. And even when we look at this, we're seeing a bit of an improvement over the last week or so. When we look at S&P growth to value, it's when we start looking at the end of day charts, we're not really seeing any follow through of strength. Small cap growth to value, it's just not doing well. Mid cap growth to value, not doing well. In fact, we're seeing a death cross here with this ratio. And even S&P growth to value, not really breaking out. We want to see this going up higher. Now, this ratio can go down and the S&P can still go up. It's just a more healthy environment when we're seeing growth. This is buy low, sell high type of stocks. When this ratio is going up, we tend to be more positive. And we are more positive here. This is a couple of ETFs where we measure growth versus value this way. We're up out of the rainbow and actually advancing here. So that's looking a lot better. But all of these different things, the indexes that we follow, the ETFs, they're all calculated in a little different way. That's why I use a lot of different charts here. We also compare discretionary versus staples. Not really seeing anything. I'm looking at the ratio on the very bottom. And it's not so much that discretionary is breaking out. It's right on its 50-day moving average. It's that we've seen some recent weakness with staples, and that's why this ratio has been going up. We want to see discretionary going up, staples going down because that's more defensive, and then this ratio going up because of that. We look at some other growth to value ratios here. The Qs to S&P showing some improvement. Discretionary to S&P coming up a little bit, but still below a declining moving average. We are seeing some improvement when we look at large cap growth versus large cap value, but we want to see more follow through with this. So the large caps are looking better, but we're not seeing an improvement with the mid caps. We have a declining moving average and we're just back up to that moving average. We're a little bit above with the small caps, but we want to see all of these going higher for things to be more positive. We look at the staple sector, which again is more defensive. That's what the market gets into. This is 2022. This is when staples were outperforming the tech sector. Well, when we're in a more growth environment, we see this ratio going down. That means that tech is outperforming staples. We had come up, we were starting to fall, but we want to see this ratio continue to decline. Now, I could have put this on the positive side, but until we break through these lows with this ratio, I'm a little bit suspect of that. This is a negative divergence with a different way of applying Dow theory, where instead of using the Dow, we use the S&P. And instead of using the S&P, we use the S&P equal weight. On the bottom, instead of using the transports, we use the NASDAQ. And instead of using the NASDAQs, we use the QQQs, which is the NASDAQ 100. And instead of using the QQQs, we use the QQQ equal weight ETF. The negative divergence that we're seeing here is we've set recent all-time highs with the S&P. That's not being confirmed by these equal weight indexes. That means that there's just a small number of stocks that are really leading to the strength in the market right now. Now, this is still positive, and they're not too far from their highs, but we would like to see more of a confirmation here, just showing that there's more than just a few stocks that are participating in the upward move. Then we look at 1 to 3 month T-bills, which is cash, and compare it with 3 to 7 year bonds. We are in an uptrend. In a more positive environment, we want to be in a downtrend with this ratio. This is when there's uncertainty about interest rates and what the Fed's going to do and what's going to happen with inflation. We're going up again as there's some uncertainty in the market. We're seeing that same thing when we look at 1 to 3 year bonds versus 3 to 7 year bonds. This came down to the bottom end of the rainbow, and now it's starting to bounce back up. This is going back up overall. We want to see this decline to be more positive. Similar thing here with TIPS versus 7 to 10 year treasury bonds. TIPS are what folks get into when they're worried about inflation and interest rates. That's when they outperform. When this is going down, that's when folks aren't as concerned about inflation. Well, now it's starting to go back up again. So there's some worries out there as they're trying to figure out what the Fed's going to do and what's going to happen with inflation. We are going to get CPI and PPI in the upcoming week. Those are big inflation reports. We look at home construction versus 3 to 7 year bonds. This had been holding up, but it's starting to fall back now. We're coming more inside of the middle part of the rainbow currently. That's a bit of a concern. Home construction is a very highly sensitive interest rate and type of the market. We look at a ratio between the S&P and utilities. When this is going up, that means the S&P is outperforming. When this is going down, that means the S&P is underperforming. We did tick back up, but we want to see this really turn and start to go up to be more positive for the S&P. Similar thing here with staples to the S&P. We want to see this ratio continue to go down. That means the S&P is outperforming. And we have been declining overall here, but we want to break below these lows that we saw earlier on. The staple sector, this is more defensive. These are things like toilet paper, toothpaste, things that you have to have no matter what's going on in the economy. And when this is really going up, that means the market is getting more defensive. Look at how it was really going up into the end of 2021, and then we got into 2022. That's when the market really started to run into trouble. Well, this going up, it doesn't necessarily mean things are going to fall apart because this has been going on for quite a while now. We're just watching this because it's a more defensive area of the market. We're looking at a similar thing with utilities. They are coming down off of recent all-time highs, but they've just been screaming to the upside. And late 2021, this is when we saw utilities doing better and outperforming. And then they also ran into some problems. As the stock market was starting to go back up, utilities were going down. Another defensive area is healthcare. You have to have healthcare no matter what's happening economically. We're showing some improvement here when we just looked at this sector. We are in an uptrend and we're above both the 50 and 200-day moving averages. Then we have this thing called the Hindenburg Omen. The perma bears love this thing and they're just sure as anything that the market's just going to fall apart. Well, there's some things that have to happen for this to actually be real. We did see a spike up. Now, what we need to see before about the end of June is a second spike. That would be a confirmation within 20 trading days of this first spike. We had one back in February, but we never got the confirmation. And then the market ended up going up after that. If we see a second spike, that could be quite negative. You can see other times when we saw multiple spikes. This is before our real decline we saw in 2019. This is before the COVID crash. This is before we started to decline in 2022. So we want to pay attention to this and just see if in the upcoming days we get a confirmation signal. Until we do, it's just something we're watching. We also are keeping an eye on the dollar. It did see some weakness this past week, but it's still in an uptrend. The dollar going down tends to be positive for stocks. The dollar going up is more negative for stocks because of conversion rates and import and export relationships that go on there. Thank you. I really hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.